Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hegren. Hey, Doug.
Hey, Kirk. Another good Friday with you.
Happy Friday. Well, it's not so happy Friday in the U.S. today because Team USA lost to Team Canada in an overtime win, which I have to say I was obviously disappointed. I was Team USA, and I don't have my shirt in front of me, but I probably should have worn it for the podcast.
I'm a little confused, Kirk. Didn't the Team USA beat Canada like a week ago? And I mean literally.
Yeah, they beat them to a pulp, and I have to give them credit. It was an exciting game. I'm going to actually go back and watch it again. Yeah, the one last night was a lot more finesse, and it was a little disappointing. I mean, they lost to Kachuk in the third period when it was an obvious loss. Like you could see that things changed. I mean, Team Canada was basically an all-star team. I mean, they were just some of the best players in the world, on that team, and kudos to them for winning. But obviously would have liked to see USA won. But it was a great game to watch, and it was overtime, so they definitely went a little extra longer. But yeah, for anybody who's a hockey fan, I guess the tickets were going. Somebody was telling me they're going for like $8,000 or something like that if you wanted a ticket last minute. And I'm not sure I would have spent that to get to that game, but it was good. It was a good game. I'm just glad I was at home. Anyway, so a little disappointing, but great game. Glad I got to see it. A few years ago, I got to see the I think it was the Penguins played the Bruins on Fenway Park. So every year, Fenway Park, they put a rink up and they give people a chance to play, and like high schools play each other. So it's a really cool experience. My son got to play on that rink 3 years ago. His team got to scrimmage there, so that was fun. So I got to go on there and walk around the park, and it was pretty cool. But anyway, so I got to see that winter. I forget what it was called, the Winter Classic, where they wore the old game jerseys from like decades ago. So it was kind of cool. Anyway, that's my hockey for the day. But yeah, let's get started here. So I want to talk a little bit about valuation today, and we're going to go through a bunch of different charts. But I want to just kind of lay things out because I think that you hear a lot about valuations, and generally they're meaningless. Because if you think about valuations, the important part is that they can be really expensive for a long time. So anytime you hear like, oh, it's really expensive, I'm not going to buy it. Expensive to compare to what? Right? It's always relative. And the other part is what most people don't see is sometimes the metric they're comparing it to is not the right metric. So if you're saying, well, it compared to the PE, it's a really expensive PE. Well, if the company's growing at 30 or 50% a year, then it can afford to have an expensive PE compared to a company that's growing at maybe 5% a year. Now, if a company 5% a year has a 30 PE and a company growing at 30% a year has a 30 PE, well, the 30 PE is better, right? The one that's growing at 30% is better because it's growing faster and it's priced less in comparison to the other one. So we're always comparing one thing against the other. So anytime you see fake news or chart crimes that say it's really expensive, including on the show. I mean, we do it as to prove a point. We're not doing it to say, oh, it's really expensive, you shouldn't touch the market. I can say there are times where I feel that way. Like we were out of the market in the summer of 2007 before it all hit because I was like, this is crazy. Like I knew some of the stuff was going on. Some friends had clued me in and I was like, yeah, this is crazy, we're out. But in general, you don't get rewarded for jumping out of high value, expensive markets because they can remain expensive for a long time. But if you hadn't bought Amazon or Nvidia or any of these companies because they were too expensive, you would have lost out on huge gains because they kept going up because they were growing so fast that the high PE was warranted. And so you just have to keep things in mind when you're investing is what are you measuring against? What are you comparing it against? Is it an accurate measure? Like you can't compare PE in the US to PE in, and by the way, this price earnings ratio, for those of you who don't know what PE is. You can't compare PE in the US to PE in like Greece because they don't look at PE the same way there. They're maybe a price to sales might be a better metric for Greece. So, the accounting rules are technically similar or the same, but they also look at things differently, and they run their numbers a little differently in other countries. So I'm not saying their version's wrong and ours is right. I'm just saying they're different. You have to be aware of that. So if you're looking at the wrong metric, the wrong ratio, the wrong comparison, you could make very, very bad mistakes because you don't realize that your metric is not useful. And this happens a lot in finance, where people are like, "Oh, I use this metric," and I'm trying to think of a good example. Well, look at technical trading, like, "Oh, the 200-day moving average." Well, for some stocks that works really well. Some stocks it doesn't work really well, right? Depends on what you're comparing it to. So you have to keep in mind that while there's a lot of these ratios and metrics and comparisons and valuations, there's always the question you should be asking yourself, is this the appropriate version? Now, we're going to share some today that are different versions of valuation that will give you somewhat of an idea of how we're looking at markets and why we're saying it's expensive. I'm very I've said this in the show in the last few weeks. I'm cautiously optimistic about this administration and what it's going to do. I think there are going to be some big paradigm shifts going on in a good way, but it doesn't mean the stock market's going to go up. So we have to disconnect positive sentiments with the stock market because they're not necessarily the same. The stock, people were afraid of the dot-com bubble way before it burst, and they got out, right? The sentiment was scary. Right now, sentiment is weird, right? Everyone's bearish. The stock market's at all-time highs. Everyone's bearish. That's not normal. Usually at all-time highs, it's sentiment's off the chart bullish. We're not seeing that. So that's weird. It's not, there's nothing wrong about it. It's more, isn't that interesting? And that's what you have to look at when you're looking through all these measures. Sometimes if you say, isn't that interesting? It should cause you to stop and think, what am I missing? Because it should align. And if it's not aligned, maybe your thesis is incorrect. Maybe you're missing something. Maybe you should reconsider your decisions, right? So this is the benefit and the challenge at the same time of looking at a lot of different data points and metrics, is because you're going to see things conflicting that don't make sense. And then you say, well, what do I do now? And you might not have an answer. And sometimes the best answer is do nothing. Or maybe the answer is, you know what? I've got a lot on the table here. Let's say you've got, 75% of your wealth tied up in one stock. Well, maybe I should diversify a little bit. Maybe I should, buy some puts on that, right? Or collar the position or something, right? Come up with some strategy that's going to reduce your risk because you think things are going to get a little dicey. I mean, that's the kind of stuff that we look at, is how do you turn this situation into something that's a little bit more reasonable of a result?
I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says, you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today.
So, Doug, you want to start us off? Because I gotta edit some of these charts here so that I take out the names, because I want to show charts as an example, but I don't exactly want to show the name because I don't want to get in trouble. So I don't know. You want to start? You want to pick one out and start?
Yeah. So while you're looking that up, sure. There is, if we're going to, let me just kind of talk high level for a second. So if we're going to talk about the current market landscape, first of all, I do want to, add this as a little bit of levity. Yeah, I mean, the stock market may be overvalued right now. And you could look at, well, if that's the case, best time to invest was 20 years ago. Second best time is today. Unless, of course, that overvalue is equal to the Beanie Baby collection of 1998, then that would be a little bit of a problem. But the reality is, even avocado toast, many people would argue is overvalued, but that's not actually ever stopped anybody from really, buying into it. So keep this in mind when we say, like, what we're talking about here, nobody knows what that means. Like Kirk was saying, it could be overvalued. It probably is overvalued. There's a lot of data that says it is. Now, there's always some conflicting information that says that it may not be. And so there's some definite pros and cons to, to everything that we're talking about. But, right now, so the current, it's a complex picture. Indicators are suggesting potential overvaluation, especially amongst mainly major technology companies. Just keep that in mind, the technology area, without going specific. There is, if we take a look at the S&P 500 cyclically adjusted price to earnings, the CAPE ratio, that reached 37.9 in December of 2024. That is significantly above its long-term average of 17.6. Historically, such elevated levels have preceded market corrections, but here's the counterpoint to that. There's analysts out there that are arguing the traditional valuation metrics may not fully capture the current market dynamics, and especially with the growth of technology companies like you were talking about with higher P and higher growth and lower interest rates, which, I mean, they've gone up, but they're still historically low. Those could justify higher valuations. Do the raising and interest rates put pressure on technology companies? Absolutely. Obviously, growth companies need to be able to capitalize on that growth. There is a market capitalization concentration. We've talked about that before. As at the end of the year, the S&P 500 accounted for 51% of the global stock market value. And that's a significant portion concentrated in a large technology firms. And if you take a look at the top 10 concentration, it's really been for some time technology companies plus Warren Buffett's Berkshire Hathaway. That's kind of how it's looked for an extended period of time. And of course, that's going to raise concerns over market vulnerability to the performance of those specific companies. Now, on the other hand, there's, proponents will suggest that these leading technology companies have robust business models and substantial cash reserves, especially one, named after a fruit. So that could potentially justify dominant market positions and valuations if they can, of course, use have those cash reserves, weather storms, and of course, put them to good use. One thing that came up recently that I think is certainly to note is despite strong earnings, major tech companies, they are facing free cash flow pressures. That's due to substantial capital expenditures I talk about, especially around AI. I think this is really important to look at. The shift goes from cash rich to capital intensive operations, which is very different for their model. And that does raise concerns about sustainability of free cash flows. And we have seen free cash flows in the S&P 500 plummet to some of the lowest levels we've seen in a long time. Free cash flow obviously allows for a lot of ability to weather different types of economic volatility. And we've also, we've talked about how CIOs, CTOs have said that, especially at large companies, they're not yet seeing the return on their investment of AI. AI is definitely creating efficiencies, but is it creating profit centers? And I think that's something that we might be a little bit ahead of ourselves on. These could obviously, these investments could lead to long-term growth and increased profitability, which may offset those short-term cash flow challenges. And just, a couple other things, there's a global equity market shift. We've talked about, that there's some projections out there. The U.S. share of global equity market capitalization will decline to 35% by 2030. That could mean that emerging markets like China and India collectively reach the same share. That's going to be unprecedented in that balance. And that could obviously impact valuations, investment strategies focused on, heavily on U.S. markets. Again, if the S&P 500 has been driving everything, and that is U.S. companies, that shift is going to take away from some of the support that the S&P 500's had for a long time. On the other hand, the U.S. market has historically dominated resilience and innovation. It may continue to offer competitive investment opportunities despite growing prominence of emerging markets. And as we talked about last week, depending on some of the things that the administration wants to do, that may put pressure on, the U.S. dollar and, of course, other countries in terms of what they consider to be advantageous if it's going to potentially directly impact them to impact us. So we've seen decreases on the S&P 500. We've seen decreases in a number of technology companies, not getting into specifics. And that's shown a little bit more volatility there. And just kind of the last thing, just the implications for investors, and then I'll turn it back to you, Kirk, is that if we take a look at the combination of high valuations, market concentration, potential free cash flow challenges, that suggests that at the very least, investors should exercise caution. Just be aware, right? That's all. Like you said, diversifying your portfolios, critically assessing the sustainability of current valuations are prudent steps. This is one of the areas that I firmly believe in, is that we've been in an area where you can talk repeatedly about the markets, and you see this, and especially FinTwit, you see these people all talk about the growth of the S&P 500 over time, and just the only place to invest. Even Warren Capital said that that's where everybody should put it. If you look historically, that has not been the case, right? The S&P 500 has been strong for periods of time. It was terrible between 2000 and 2013. It's been booming again. And so, one place to have your money is never going to be a very good strategy for the long term. And the other thing to think about too is that if we do get into a crunch, and if everybody is following that methodology of just keep everything in the market and rely on growth and rates of return that have been pushed to, extreme levels. I mean, if you go back 10, 15 years ago, Kirk, after the Great Recession, and you look at the historic average of the S&P 500, it actually plummeted, since 2000 to down to 3 to 4%. Now, of course, with this bigger run, now everybody looks back and say, look, it does now, 10 to 12% every year. That's in a bubble. So the last thing I'll say is, I think it's really, really important that no matter what happens, if we do see a shift, and if, of course, all those assets that you have do get subject to greater volatility or potentially at risk if we are overvalued and there's a snapback, it's a good time to also reassess liquidity and access to capital. Buffett's been doing this, right? He does this with his dividends. He's keeping a lot of cash there, not because he's scared of the markets, but because he wants to be able to be what he's always been. And that's opportunistic if there becomes an opportunity to buy things in at a lower and maybe more well-valued level than they are right now. So he's not deploying everything either. Unfortunately, from what I see, is most people have everything invested in that risk tank. Everything's in the market. And the issue is that if it turns out that something does go wrong in the markets and we get that snapback, what are your options? So that's why I think that part of that diversification would be having a source of liquidity or access to capital so that you can be nimble.
Yeah. So before we get into the valuation part and the example I wanted to share a chart crime. I forgot about this, or I would have done this earlier. So this is basically U.S. labor productivity versus employment growth. So this was done by, I believe it was KKR did this chart. It basically shows productivity in the 70s and in the 60s, the 2010s and the 90s and aughts. What's missing here, Doug?
Well, any breakdown of I guess we do have years at the top. Let's see, what is missing here? I mean, I don't see years across the bottom. You tell me, Kirk.
Okay. I'll have to call it out because I didn't see this the first time. I was looking at this and it took me 10 minutes and I was like, wait a minute, there's something missing here.
We don't have 10 minutes on a podcast. You go ahead and lead me to the finish line.
We'll put on the Jeopardy music and while we wait for Doug. No, so what's missing here is the 1980s.
Oh, shoot.
There's a whole decade that's missing. We got the 60s, the 70s, the 90s, the 10s. And I was looking at it, I'm like, wait. And I was like, where's the 80s?
And they do a really good job of, I mean, you don't see it. It's like looking at the same thing over and over and missing the words right in front of your face. Yeah, it's not there.
Yeah, it's just not there. And even the aughts were lumped in with the 90s, but it just wasn't there. And I'm like, wait a minute, what the hell's going on? Anyway, so I just point this out because it wasn't obvious to me, but after I sat with them, like, wait a minute. Like, because the 80s are a weird period. And that's why, like, them omitting it's kind of like, I'm like, this is a little too uniform. And it basically shows, like, employment growth versus productivity growth, stuff like that. So it's just more interesting. Like, the listeners are probably going to like glaze their eyes over on this, but I thought it was interesting just because everything seems to fit in certain quadrants. But I also thought it was fascinating because you're missing a whole decade, which I'm sure does not fit in the quadrants, which is why it was omitted. And that's why we talk about chart crimes here, because frequently things will be omitted, when they don't fit into the narrative that people are trying to portray. All right. So
I just want to just say this too. Blending the 90s with the aughts is an extreme chart crime, because what did they have to do to put those two things together to create that data? That's offensive. I think really, but the end of the 1970s all the way up to 2020, they pretty much glazed over everything that happened there over the last 20 years, which
I'm sure if the 80s fit in one of the boxes, they would have put it in there. So it obviously didn't fit. All right. So I'm going to share 3 charts with a company. I pulled this from somewhere else. Sorry, it's black. You probably can't see it too well, but I pulled it last minute because I was thinking about this. I'm like, this is interesting. So we were talking about ratios and valuations, and we're going to show more broad spectrum valuation. But here's a company, I whited out the name because it's a black chart. So you can't see the company. You might even be able to figure it out if you're really a sleuth, but there's not really enough information here to do that. So here's a company, and we're showing the trailing 12-month revenues. So starting somewhere around 2021 until today, revenue hasn't grown. Now, it did a great job growing from 2010 to 2021. So you had a good 11-year run where it was growing at a pretty good clip, a very good clip. And then, of course, it's been flattening out for the last 4 years. Okay. Now, take that as exhibit number 1. Okay. Exhibit number 2, we have. All right. Here's exhibit number 2. This company trades at a 57% premium to the average PE. So we've got, basically the orange line is the average PE, somewhere around a little above 20. And you've got the premium or discount to the average PE, right? So the average PE is 21. Sometimes it goes down to 10. Sometimes it went up to 30, 33. And so if you're looking at this, you're like, well, wait a minute, this doesn't make any sense. Why is, it's at not at the very highest, but it's very close to the highest price to earnings. Okay. Let's take chart number 3, which is right now it's trading at a 85% premium to the average price to free cash flow. Now, price to free cash flow is another metric that people use. Obviously, you can see here it is a lower left to upper right line where it keeps increasing. So now it's at 40, looks like about 42 as of today. And that's 85% premium to the average price to free cash flow. You don't want to buy a stock when it's at a huge premium to the price to free cash flow. You want to buy a stock which is a low price to free cash flow, right? Because free cash flow is something that they can't really hide, right? That's something that here's the cash we're earning, right? We're not talking about EBITDA. We're not talking about metrics that you can mess around with. This is like hard, cold cash. So I want people to start thinking about, I'm not going to say what company it is because I don't want to really get into that. And I don't want compliance breathing down my neck. But I do want you guys and gals out there to start thinking about the fact that that's an example. It's a name so it's not a name that you've never heard of. It's a name you've definitely heard of. You probably use it every day. And what you need to understand is that things are really expensive right now. Now, I'm going to share some other broad-based metrics as well. Here's the first one. It is, let's see. It's fair value based on CAPE ratio, which is basically cyclically adjusted PE ratio and price to book. So if you're using these metrics, right, we're seeing right now where the stock market is a huge overvaluation. Now, if you looked at the tech bubble, it was very similar. It doesn't mean we can't get more expensive, but if you're just using this chart as a guide, which I think is a reasonable guide for like the last, what is that, like 40 years, somewhere thereabouts.
You make me feel old, Kirk. That doesn't look like that should be 40 years ago, but I think you're right.
I think it's about 40, yeah. So you're looking at this, it's like, all right, you want to buy when it's to the lower end of the range, you want to sell when it's the higher end of the range. The problem is the higher end of the range can get really expensive. So you see here, we got really expensive in the .com bubble. It got moderately expensive in the housing bubble, but of course that was a bubble in housing, not on stocks. And right now you had a bubble right around 2020, which went down and then it's back up. So right now I don't know if it's the highest it's ever been. I think tech was higher, but it's still very, very expensive in comparison to the market. Here's another metric. The risk and sentiment indicators. So this is looking at the blue lines. The vertical blue lines are global bear markets, and then you have the Goldman Sachs bull bear market indicator. So what this basically means is, if you're looking at this, I'll translate it for you. At the top, where it's red at the top, 73% right now, which is one of the highest it's been ever, or at least in the last 75 years. And if you look here at the tops, these are always tops that really precede a bear market. Not always, because there was one in the late 60s that went down and back up. But if you look at them, they almost always precede a bear market. Now, we haven't seen a bear market yet. Of course, a few years ago, Biden decided it wasn't a bear market, so it wasn't, even though I think economists generally agree it probably was. But recessions are dictated by a government agency, so or at least an NGO. So, but if you're looking at it, the sentiment is at all-time highs, right, or close to all-time highs. So that's something to keep in mind. That's usually not bullish. It's not bearish. I want to be clear. That doesn't mean it's bearish. It just means it's not bullish. The best times to buy is when everybody's bearish. It's not going to say it's the best time to sell when everybody's bullish, because it could stay up there for a while, just to be clear. But I want you to just put it as a data point as, okay, things are expensive. Moving on, right? Here's another one. Stock market valuation based on the S&P 500 companies' book values and dividends for like the last 97 years, it looks like. I'm not sure why they did that, but anyway. So it shows all these different data points. Now, if you look here, what they're doing is they're comparing on one axis the S&P price to book, and they're doing it by year, and then on the x-axis they're doing S&P 500 annualized dividend yield. So what you'll see is there's a box where it says the normal range of stock market valuations for the most part. And then you'll notice at the upper right part of the chart is where it's really expensive, which is kind of where we are now. It's questionable as to whether 2023 or 24 was the most expensive. But if you're looking at it, we're at a very expensive, even 2000 was still within the reasonable range of what you'd expect. But this is kind of an outlier, because right now we have low dividend yields, and you have, although they're higher than the normal, but they're 2024 is probably on this the highest price to book value that we've seen. It's above 7. That's a bit of a problem, right? It's just saying that in general, as a stock market, you want to be cautious because things are just overall overvalued. You can find undervalued companies there, but it just means that as a whole, there's a lot of overvaluation. You want to take some of these, Doug? You put some of these in. I'll let you do some and go back.
Yep, absolutely. If you want to throw one up there.
Yeah, we'll just go down the line.
Okay, sounds good. So kind of going back to the first one that it was actually noted on the last chart, the dividend yield. This is something that has been declining significantly for, a trend, extended trend line. The only time that the dividend yield was lower than it is right now was in 2000, which is right before obviously the crash. And then of course dividends went up from there. Dividend yield can often be an indicator of a ratio of what they're paying versus their stock price, right? So if their dividend stays the same and the stock price is higher, your dividend yield is going to be lower. So again, that's another indicator of potential overweight. The other one is the Shiller PE ratio. The Shiller PE ratio is now 31. Now this was really, I think, based on the end of the year, so it's moved a little bit since then. But the Shiller PE ratio is at 31, suggests that the U.S. stock market is 19% overvalued. And if we use that, we can see the stock market was extremely overvalued. When? 1929 wasn't a great year. 2000 didn't end up being a great year. And 2021, and we saw kind of what happened going into 2022, wasn't a great year. They reached peaks of 32, 42, and 38 respectively. So if we take a look at the 31, it is still lower than the two other indicators. What I thought was interesting is if we go into 2021, it was at 38. So historically it's 16, it's now at 36. Okay, so moving to the next one. This one is the Buffett indicator. The Buffett indicator is the ratio of total United States stock market to GDP. Historically, it can fluctuate a lot. It expresses the value of the U.S. stock market in terms of the size of the U.S. economy. If the stock market value is growing much faster than the actual economy, then it may be in a bubble. Right now, that ratio of 211% is approximately 66.99% or 2.2 standard deviations above the historical trend line. That would suggest a strongly overvalued in relative to GDP.
That's a lot in technical terms.
That is a lot in technical terms. And again, if you want to jump to the next one, I believe that one actually gets into inflation adjusted S&P with trend line. So if you take a look at, as of December 31st, 2024, the S&P 500 at 5882 was about 72% above the long-term trend line. Okay, so that is, and again, you take a look at where it has exceeded that long-term trend line historically along that chart going back to 1950. There has now 2000. Remember, it's 72% above. The higher you get, the higher the number is going to be above to create that percentage. So I don't have on here the ability to tell you to what percentage in 2000 that was above the trend line based on the trend line being lower. Look like it could be close to that same kind of almost a 70 or 80%. So clearly 2000 was a problem. But what I found interesting in there too is where that trend line happened after 2020, and we were already moving into 2020. Well, again, we've talked about this before. When COVID happened, Kirk, you know this. It was already cause for caution around the time that COVID happened because there was already starting to be an extreme overvaluation at that point. COVID was just the black swan that really caused it to pop. All right, go into the last one. I think it was in my charts here. This one just goes back into the standard deviation. So if we take a look going back to 1950 of where we've gotten into standard deviations, only in the mid 1960s did it get to 2 standard deviations before it got to the internet bubble. What I found was really interesting from this chart is as bad as the financial crisis was in 2008, it actually arguably was fairly valued in 2007, 2008 before the crash. Now, you can translate this a lot of different ways, but what it really, I think, is more telling than anything is that what happened in 2007 and 2008 was not an isolated event in itself. It was a continuation of what was built into the system from the pop of 2000. Think of this. How many billions and trillions of dollars went up in smoke with the dot-com implosion? I mean, companies were selling for $30 billion that had never produced any revenue. That money had to disappear somewhere, and it shifted. And you know where it shifted? A lot of it shifted to real estate. Okay, that's when we had that push on real estate and so a lot of the pain of .com did not get fully felt. And so in itself, we really were not, as a market standpoint, standard deviations above the trend line in 2007, 2008. But what this really was more of a secular, instead of a cyclical situation, which is a shorter term trend. Yeah, it's a continuation of the secular trend that probably started in 2000. But what is interesting is that if you get back up to 2020. We hit that trend line, probably would have pushed through, but there was a lot of people being, cautious at that point. We had the Black Swan event. But again, look at what happened in 2021, 2022. We all know that we had a really rough year in 2022, 2023. I'm, thinking of my years now, but we're right back on that. Historically, I can't remember if it was Merrill Lynch, Morgan Stanley, or Goldman. One of them had looked that whenever the S&P 500 had hit 2 standard deviations, the percentage risk of a pullback extremely high. And I can't remember if it was hitting 2 or 3. Once it hit that, it was 100%. I believe it was. And so it looks like, and I think it was historically when it hit 2 standard deviations, it was a pullback because none of these look like they ever hit 3. So does that mean there's 100% chance that the forward is going to be a pullback now that we've hit 2 standard deviations? Absolutely not. Okay. Historic does not represent future. But again, does that mean that there's probably a very good sign that we are overvalued? Absolutely.
Yeah, and I think it's, what you have to keep in mind here is we all tend to think in a binary fashion. Human beings are black or white, right or wrong, on or off. We think in binary terms. And what you have to realize is when you're investing, and actually this applies to life in general, most people are what we would call outcome-based thinking. Now, outcome-based thinking is where you have, let's say you have the presidential election. Who's going to win? Well, I think Trump's going to win. I think Kamala's going to win. Or a third option, which was, it was a potential option, was it's unclear, right? Or it's going to rain today, or it's going to be sunny today. Like, who's going to win the ball game? I think the Red Sox are going to win, right? We think in binary terms. I think this is going to happen. Yet, we as human beings were wired to be outcome-based thinking creatures. We're always predicting the future. You know what? We're terrible at it. We're horrendous at it. I have a weather app and it says, hey, it's raining out and there's no clouds in the sky and it's perfectly sunny, right? We're terrible at predicting, even if it's our profession, right? Any professional is, right? You got all these handicappers, you got these bettors, you got Wall Street gurus. They're just guessing. No one knows the future. You're just trying to, best guess what's the best probability guess of what the future is going to be. But we don't know. No one does. So we have to change rather than trying. So you can do one of two things. Your brain works like this. You know that you're trying to predict. You know you're bad at it. So how do you solve that? Well, it's actually rather simple. Rather than doing an outcome-based thinking approach, you change your mental framework so you're scenario-based thinking. Scenario-based thinking is like, the last election. What are we going to do? Let's say you're an investor, right? Because that's what we're talking about. We're an investor show. What are we going to do if Trump wins? What are we going to do if Kamala wins? Or what are we going to do if it's unclear? We would prepare for all 3 of those scenarios. And because we have a plan in place for all 3 scenarios, one of them is inevitably going to happen. Now, if I was betting on the outcome of the election, I don't bet on elections, but let's say it was 50-50, right? You don't really know. So you're like, all right, I'm going to do this. Well, what if you're wrong? Take George Soros. He bet on Hillary against Trump, and he lost billions of dollars because he bet wrong. And knowing him, he bets big. So he's typically he's a pig when he bets on things. And he was wrong, and he had to reverse his opinion, right? I'm willing to bet he didn't say, oh crap, well, I hope things change, and then it just gets worse. No, I'll bet what happened was he had his plan, he was wrong, sold everything, and if anything, he went the other way and said, oh, well, Trump won, I got my plan for Trump, but I'm going to go there, right? And he doesn't like Trump, let's be honest. Like he's a weirdo, but he's no fan of Trump. But he's also an investor and knows that it's not an emotional decision. Like, well, Trump's winning, then these things are going to happen. So when you think about scenario-based thinking, the idea is you carve out different scenarios and you plan for each. So when it happens, you can take your game plan off your mental shelf and put it in action. And you're not going to stop and say, oh my God, what are we going to do? And then 5 weeks later, you do something, right? It's too late, right? You have to have a plan. So any good investor does this, right? Now, most investors are emotionally tied to their positions. They're like, oh, it's down. I got to wait for it to come back. Oh my God, I need to buy more. It's down more. I need to double down. And you get into this gambler mentality rather than saying, well, I was wrong, moving on. it happens to us time to time. We invest in a stock and it doesn't do what we expected and we sell out and then it comes back up. Well, I've already moved on. I'm not buying back into that stock because I'm going to wait for another one. I'm not going to sit around and try to guess whether I'm right or not. I'm just going to move on and find something that is working. So as an investor, you do have to keep this in mind. So here's this is something we talked about earlier, but wanted to share it. This is the AAII survey of respondents that are bearish on stock. We're not at all-time highs, but we're pretty high on the number of people that think we're bearish on stocks. So I want everyone to keep in mind that whatever we're saying here today, it's to help you put things into context. Because we know that whatever we say, there's a certain percentage of probability that we're incorrect. That's why we're not telling you what to do on this show. We're giving you perspectives on how to think about investing, not what to think. That's why we don't share the stock price of the stock earlier. You might be able to figure it out, but I'm not sharing that because I want you to figure out, I want you to learn from the example and not get caught up on, well, this is ABC stock and I know about this and he's wrong. Who cares what I'm right or wrong? That's not the point. We're teaching you a lesson about how to think about these things. Now, people widely like that stock and they think it's going to go to the moon and all these other things. But if you look at the numbers, it doesn't line up. So what do? I don't know. If it was me, I would move on. There's plenty of stocks out there that don't look like that. And maybe those would be better bets. I don't know. But either way, I think what's best to keep in mind is to look at the data, figure out where your comfort zone is, like Warren Buffett, like Doug shared the Warren Buffett indicator. I don't have a graphical chart, which I love those better, but I don't have one in front of me. But the Warren Buffett indicator is, I don't think it said it's all-time high, but it's really close to it. And the way Warren Buffett looks at things is, and this is why it's called the Buffett indicator, is because he uses it to gauge an overall valuation of the market. He's been doing it for a long time. It's a great indicator. I like it. I think his indicator is faulty at the moment because the markets have fundamentally changed. And so unless you're updating your metrics, you could kind of get squeezed. Yes, it's expensive, but as we said in the show before, last few months, it could get a lot more expensive and things aren't making sense and they might not continue not to make sense because the markets have changed. And the question is, do we have this perpetual bid under the market that keeps pushing it up regardless of fundamentals? We're going to find out because while I'm cautiously optimistic on the markets, I also think that we could very easily see a market sell-off this year or next, which is 20, 30, even 40%. I think it's possible. And all that without the world ending, right? It could be just, hey, it's time to sell the market off because it's too expensive and people need to, kind of reset the system a little bit. Usually it happens about once a year. We got one last year when Japan got a little screwy, but usually it happens about once or twice a year. And it's a good buying opportunity if you're prepared. But Buffett is trimming down his portfolio in many ways, raising a lot of cash, and he's just sitting there, just waiting. And I guarantee you, if we have a massive destructive market event, he's going to come in with his bag of cash and start paying people off and get sweetheart deals because he's one of the only people with cash. So don't be afraid of cash. We're going to talk about some kind of marketing rule or stock market rules of thumb over the next few weeks, because I think people need to really understand the truth behind some of these rules of thumb is that they're what Ben Franklin called a half truth, which is they're mostly true, which makes you believe them, but they're not entirely true. And that last small percentage that's not true is what screws everybody up. And as Ben Franklin's quote was, a half truth is a big lie, right? If you're giving a half truth, it's still a lie. It's not true, right? It's like saying, well, Albert Einstein said that the seventh or eighth wonder of the world was compound interest. No, he didn't. I mean, it's a good saying. It's strong, but pairing it with Albert Einstein doesn't make it true because he didn't say it. But everyone thinks he did. So, you need to keep these things in mind. Now, that's not going to screw up your investing, but you get the point. Like, we believe a lot of half truths out there. people tell us something, it's in their best interest. Here's an example. If you miss the 10 best days in the market, you would have lost out on 7% a year annually. And, you would have had really bad returns. Okay. Well, yeah, that's a half truth. If you had missed out on the 10 worst days in the market, you would have gotten triple the performance of staying in the 10 best days. So it's not really the whole truth. You're really just kind of guiding people with a narrative, trying to get them to believe your story, right? The media does this all the time. And they're giving you a half truth, and it sounds true, but it's really not. It's not completely true because they're telling you what you want to hear. Doug, let's wrap it up here, and we'll take us home.
Sounds good. Thank you, Kirk. So for successful families, especially those with strong incomes and growing assets, the biggest financial risks aren't always those ones you see. It's the ones you don't. Most advisors focus on investments and retirement, but completely overlook one of the largest and most overlooked wealth transfers, paying for college. And when this isn't planned correctly, the collateral damage can be massive, draining after-tax dollars, limiting cash flows, and even putting your retirement at risk. And the key isn't taking on more risk or sacrificing lifestyle. It's making sure your financial decisions are structured the right way. At Mergent College Advisors, and that's MERGENT, Mergent College Advisors, we help families find and keep potentially millions of dollars by reducing unnecessary wealth transfers, minimizing taxes, and ensuring they have access to liquidity when they need it the most, especially, as we talk today, in times of market uncertainty or potential valuation highs. Because the best time to protect your wealth, well, that was yesterday. But the second best time, it's right now. So go to mergentcollegeadvisors.com to learn more. And if you have a college-bound student, don't let college costs create unnecessary collateral damage to your financial future. Get our free report, and you might be shocked at how much you can save while keeping your financial house in order.
Great. Well, Doug, always appreciate you coming on the show, sharing your wisdom with us. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.